Hey guys, welcome back to my channel. In today's video, I'll be sharing with you 3 simple steps on how I identify fundamentally sound and good companies to invest for the long term. When I talk about long-term investing, I'm referring to at least 5 to 10 years horizon. So if you're looking for ways to get rich quick in the stock market, you should just skip this video altogether. I'm 32 this year and I've been investing for about 14 years. For me, investing is more about the journey rather than the destination. Of course, setting a target on how much money you want to achieve by what age is a good goal to have, but no one can really predict the market in the near term, can we? So the best way is to have a process in place to consistently identify good opportunities to invest in the long term and let the market do the rest of the work. By investing only in fundamentally sound companies, you can definitely sleep soundly at night and not worry about the company going bankrupt the next day and losing your entire savings. The day-to-day fluctuations of the stock market will also not matter to you because you know that at the end of the day, these fundamentally good companies that you have invested in will continue to grow and increase in value over time. So let's get started. When it comes to long-term investment, the first factor to consider is whether the company has a sustainable competitive advantage or what is commonly known as a wide economic moat. The wider the economic moat or competitive advantage, the easier it is for the company to defend its profit and market share against its competitors. Because competitors won't be able to replicate their products or services easily. For long-term investing, you really need a company that's able to differentiate itself from the competitors and survive in the long run. So some examples of a competitive advantage can be things like brand monopoly. Companies like McDonald's or Amazon are very good examples of brand monopoly. Whenever you talk about a specific product or service, that's usually the first company that people will think of. So when you say e-commerce, people will often think of Amazon. Fast food, people will think of McDonald's. There are of course other brands of fast food like KFC or Taco Bell, but they just don't command as much brand recognition or power as the McDonald's brand. Economies of scale is also another form of competitive advantage. Google is a very good example of that. You can't just create a search engine or YouTube equivalent site overnight. And even if you do, you are just not able to compete with Google on the technology itself because they have already spent decades refining their search engine technology. So this creates a very strong competitive advantage for tech giants like Google because they have been in this business for so long and have grown so big that it's almost impossible for any other company to compete with them directly. The next type of competitive advantage will be high barriers to entry. Certain industries naturally enjoy very high barriers to entry due to the nature of their business. Take for example the aircraft manufacturing industry. You really need to have the technical know-how and there is a lot of upfront R&D investment required to be able to build an aircraft. So companies like Boeing, who have been in the industry for the last few decades, are naturally protected from competitors or even new entrants to the market. The last type of competitive advantage will be companies that have high switching costs. Companies like Adobe and Microsoft are very good examples of this. Once you start using their products and become hooked on it, it becomes very costly or time consuming to switch over to their competitor's product. For example, if you have been using Adobe's Photoshop or Premiere Pro and have become very good at it, sure, there are cheaper products out there that allow you to do photo and video editing as well, but you have to take the time to learn to use these new products from scratch, and time is money. So people who have been using Adobe products for a long time just naturally continue to use it even though there are cheaper alternatives out there. So that's it for competitive advantage. Do note that some companies have competitive advantage in multiple categories. Companies like Google not only have the economies of scale, but they also have the brand monopoly. End of the day, you really want to invest in companies that have as many competitive advantages as possible. Having just competitive advantage alone is not enough. Companies like Kodak still went extinct even though they had the competitive advantage because they simply didn't change and innovate with times. So apart from a strong competitive advantage, The next factor to look out for is whether the company has consistent growth in sales revenue, profit, and cash flow. The company needs to have consistent growth in all three areas and not just any one of the three. Because a company may have profit growth but declining sales revenue at the same time. And this is normally not a good sign because the company may be cutting costs to boost profit in the short term, but long-term wise, it may be losing its competitiveness and market share, and hence the sales revenue is declining. And this is a major red flag. So all three areas must have consistent growth to be considered a good candidate for long-term investing. There are many free websites that you can use to get financial information about any company. Yahoo Finance, Reuters, and investing.com just to name a few. For me, I prefer to use investing.com and I will show you why. Just type investing.com in the browser. Let's say I'm interested to check on Google. I will just type the ticker symbol GOOG in the search bar. Go under the financial summary under the financial tab. Click on the annual button and you have everything here in one place. So for Google, under the income statement section, their sales revenue has been increasing steadily over the last couple of years. So Google ticks the first checkbox. Their net income or profit has also been increasing steadily over the last few years, and that's the second checkbox. And when you scroll all the way down to the cash flow statement, you can see that Google's cash flow from operating activities have also been increasing. So that's the third checkbox. So when it comes to consistent growth, Google as a company has definitely met the criteria for all three areas. And back to the reason why I like to use investing.com over other sites like Yahoo or Reuters. If you head to the ratios under the financials tab, this page shows you a quick summary of all the financial ratios of not just the company you are searching for, in this case Google, but also the financial ratios of the industry average as well. This is definitely very useful to see how the company you're interested in fares against its competitors in the exact same industry. If you scroll down, you can see that Google has a really high net profit margin as compared to the competitors in the same industry. The revenue per share, EPS, book value per share, cash flow per share are all significantly higher than the industry average. And this goes to show that Google really has a wide economic moat and a significant competitive advantage over their competitors in the same industry. The third factor to look out for is a high and consistent return on equity. The return on equity, or ROE, is defined as the amount of profit or net income a company earns per investment dollar. It's an indication of how effective the company is at turning money shareholders have invested into profits. The higher the ROE, the more successful the company is in generating cash. In general, ROEs above 15% is a good enough return. You actually don't have to calculate the ROE yourself. To look for a company's ROE, just head to investing.com again. Under the Ratios tab, scroll all the way down. You will see two return on equities. One is return on equity TTM, which stands for trailing 12 months or the last 12 months, and for Google it is at 19%. The other return on equity is the 5-year average, and for Google it is at 17.49%. Both are above 15%, and this indicates that Google has a high and consistent return on equity for the last 5 years. You can also compare the ROE with the industry average. Even though Google's ROE is slightly lower than the competitors in the same industry, Google still ticks all the checkboxes that we have discussed earlier, and it is definitely a good company to invest in the long run. So that's it. These are the three factors that I've been using to select companies for long-term investing for the last 14 years. I hope you find what I've shared earlier useful for your own investment journey. Feel free to comment down below if you have any other questions. Thanks for watching.